Thank you, Ms. Curry. If I might, Mr. Anderson, ask you for a more practical and commonplace definition of the phrase you use, global systemic risk. We've heard a considerable number of our witnesses talk about systemic risk. It has a rather bland quality to it, but it describes something that is anything but bland. What would be your description of systemic risk?
So what we mean by systemic risk is the interconnectedness of these types of risks. And a number of the other panelists also mentioned that ultimately one event has implications on supply chains, physical damage, displacement of people. And so history, as people have looked at those risks over time, they've often looked at them very separately. But with climate change, the effect that it is having on the size of the storms, the wildfires, the effects of it are actually creating risks that are so interconnected, they have to be dealt with in totality as opposed to just by individual factor.
The way that I have described this is that climate change causes weather anomalies, and those anomalies make events harder to predict. And that added difficulty of prediction compromises insurability. And as insurers either withdraw or raise prices, that has an effect in mortgage and property markets because it's very hard to buy a mortgage property if you can't insure it. And of course, without mortgages, demand for properties collapses because you're only selling to all cash buyers at that point. And when demand collapses, values collapse, and that can cause severe economic harm across the entire economic landscape. Is that a fairly accurate description of how this cascades through to from weather discrepancies to a general property values problem?
I think your underlying hypothesis that the models of old that have been used looking backwards are not as valuable to the models that need to be developed for a changing climate. So that is the underlying premise. If you're looking to match risk and capital together, the inherent sort of assumption in that is confidence that the risk that's being transferred is predicted and therefore can be priced appropriately for the risk that's assumed.
You can't insure what you can't predict.
You can't insure what you can't, because the capital will not be protected.
And so you made a comparison in your testimony between climate risk today and mortgage risk in 2008. Why did you make that comparison?
It was designed to be an example of where using the information that Freddie and Fannie had on mortgage default risk, the ability of the insurance and reinsurance industry to bring modeling capability to do the predictability, actually to understand that risk, and then bring new sources of capital into the market. That's essentially what we're talking about with climate. Ultimately, the size of the capital pools that need to be brought to bear to help manage and transfer these risks to a broader financial sort of pool of capital is ultimately our strategy in helping clients deal with this issue.
And to perhaps state the obvious, as the president of Aon Corporation, you have a fiduciary duty to your shareholders and to your employees and to your customers to try to get this right. And that requires that you pursue and obtain reliable forecasting, not just for the business reasons of making money, but also for the fiduciary reasons of not misleading anyone. Is that a fair description of the accountability that you operate under?
We take a very strong position that our opportunity to help our clients manage this risk, and when you talk about it as a client, it's not just a corporation, it's a community, it's people that live and work in that community. Our efforts around understanding and trying to predict the effects of climate change and then developing products and solutions that actually allow people to transfer that risk as best they can so that they have the funding available to either rebuild or support those displaced individuals, we view as one of our most important roles going forward.
And you can't just say what you please. You're bounded by the fiduciary duty to be truthful and accurate and operate on the best information you can find.
Of course.
Ms. Watkins, in your testimony, you talk about the ripple effects of insurance withdrawals, which I think I tried to explain in my questioning to Mr. Anderson, that can endanger entire communities and create a downward spiral that's difficult to emerge from, and in which collapse can happen quickly, often through a crisis of confidence triggered by one event. Could you elaborate a little bit on that scenario and how that plays into the problem of systemic risk and economic harm?
Yes, sir, and I do agree with your description, and I would extend it a little farther to when real estate values start dropping. Also, this is accompanied by quality of life issues. In my current home state of California, we're having power outages, smoke that can make it hard to go outside all summer long, a day where we never saw the sun because of smoke. Those sorts of things, the need to evacuate frequently, which happens a lot of times in hurricane-prone areas. That kind of uncertainty can combine together to cause people to want to leave. At that point, you have a disincentive for businesses to, establish new roots in a community. You have a reduction of the tax base. Concurrently, real estate investors and municipal bond investors are also that they're looking at climate change and making their long-term decisions, and so the influx of investment into a community that's not resilient to climate can be reduced as they're competing with communities in other areas for that kind of investment. So the tax base goes down, the cost of borrowing can go up. It can be harder and harder for a community to try to deal with the risk as even if it stayed the same. But if it's increasing, they just get squeezed. So that's what I'm talking about in terms of the downward spiral. The crisis of confidence, I think in a non-insurance example in the recent news, we have Silicon Valley Bank. The kind of last man at the bar syndrome, where the people involved in the risk who felt like they were at risk decided they were going to pull out. And that pullout could actually not only endangered that bank, but other banks that others thought were in similar situations, whether or not they had actually made the same kinds of decisions that led to Silicon Valley banks with collapse. So what we have, just for example, California, we have the California Fair Plan, which is growing unsustainably high. As the insurance market withdraws, the Fair Plan increases. It's supposed to be a crutch for the market. It's supposed to prop up the market while the market heals itself. But the problem is when policy makers decide to turn the crutch into a leg and start paying attention to protecting the crutch and making it more of a long-term solution, it's no longer an effective crutch, and it's not a very good leg either. So we're not healing the broken system in the process. Right now in California, the Fair Plan is running at a $332 million deficit. That was about a year and a half ago. Their rates are 72% inadequate at last report. They're only reinsured for a 1 in 31 year return period at last report. If the Fair Plan, whose total insured value has gone up by over 4 times in 5 years, were to have a multi-billion-dollar loss, which is very possible, there's an unlimited assessment on the California insurers who stay in the market. So every insurer who wants to stay in California, maybe they've pulled out of high-risk areas, but they're insuring low-risk areas, they are on the hook for the Fair Plan's potential insolvency in case of a large event. So
I've got to stop you there since other senators are asking to ask their questions, but thank you very much.